Hi all, thank you for scaring myself. Thank you for coming post-lunch to an amazing, very well-named Impact Finance panel where we have 3 great papers discussing the impact of finance. So we're going to start off with Alex, who is a PhD candidate from Oxford University, currently at Harvard, on discussing how sustainable finance creates impact in the real economy. And then next we'll go over to Andrew Lo, a professor at MIT, who's going to discuss the quantification of impact. And then finally bringing us home is Simon Zhu, a PhD candidate at UC Berkeley, assessing the response of mutual fund portfolios to environmental regulations. We're going to have all the presentations and then Q&A. We've got a number of really great questions already, but we would love some audience participation. So hold those questions for everyone, and I think most of the questions will probably be able to be answered by multiple of the panelists, so we're excited to get different views on your questions as well. So with that, Alex.
Thank you. Good afternoon, everyone. So I have the unenviable task of waking everyone up again after lunch, but hopefully you'll find my presentation interesting. I'm trying to keep it relatively accessible, which is a way of obfuscating the fact I don't really know what I'm talking about. But this is a paper that was written with some of my colleagues at Oxford University quite some time ago now, and to a certain degree, some of the developments in the real world have started to catch up with, some of the ideas that we were throwing around, which is a nice thing to see, but there's still a very long way to go, particularly in right now. So what we're interested in looking at is kind of getting back to basics. What's the point of sustainable finance? Well, according to most of the people who are selling it across the financial industry, it's about real world change, and specifically in the climate context, getting to net zero. But our kind of initial observation is that despite the huge rise in the use of sustainable finance instruments and massive flows of capital into this area, we really do need to discuss much more seriously what exactly we're trying to achieve, whereas most of the focus is actually on what counts as green, so the EU taxonomy efforts and so on and so forth. And it's not to say that's not valuable, but it's to say that it may be missing one of the really key components, which is not what is green, but how does finance actually make green things happen, and vice versa. So up to now, I think it's fair to say that a lot of the growth in sustainable finance is driven by, number one, risk management and the impact on creditworthiness of firms, and number two, perhaps more importantly, investor demand for ESG and impact. And what's that resulted in? Hundreds and hundreds now of ESG funds supposedly selling investments that meet certain thresholds and supposedly may or may not be fitting in with certain frameworks like the EU taxonomy and so on, but it's far from clear that they're actually achieving anything in the real economy. And by the way, this is sidestepping the question of whether finance should be doing this at all. What we're interested in understanding is how it can become what it's claiming to be in so many cases. So the starting point is that a lot of the approaches in the kind of ESG and sustainable finance world today revolve around portfolio alignment. And that's not just private institutions, it's also development banks and so on. And this isn't incompatible with having an impact, but not all alignment strategies are the same, especially where there's no evidence that they necessarily affect firms' decision-making or cost of capital and so on. So our starting point is that investing in green financial products, buying a bunch of green bonds or green equities, most of which you'd buy on the secondary market anyway, don't equal making the world greener necessarily. So what does? What I'll do in the next probably 7 minutes or so is just take you through how we've structured our analysis, and bearing in mind that this is very much a sort of hypothetical theory building exercise. There's good reasons why it hasn't been empirically tested yet, because the data in a lot of cases is not really there to do it. But this is really starting to change quite rapidly at the moment. So our hope is that some of the research directions I suggested at the end of the talk are actually in a position where we can start making progress on them. So we identified through a review of the literature basically 3 main transmission mechanisms that link changes in the financial economy to the real economy. The first is quite obvious. It's the cost of capital faced by borrowers. That in turn is comprised of the cost of equity and cost of debt. And these are very, very different, as we'll come to see when it comes to the actions required to make a difference to them. Second is access to liquidity, which is subtly different. So liquidity is the ability to convert assets into cash, And access to liquidity refers to the pool of investment capital that you may be able to access as a firm. And the third, which broadly speaking is referred to as engagement in the literature, is influencing sustainable corporate management and practices. And at the bottom here, I've got spillover effects to the rest of the economy because, as we've shown this schematic, although, of course, all three of these mechanisms influence each other, but they also have spillover effects on other firms and on the macro environment in general, and they're all situated within a risk environment that dictates how willing banks are to lend or investors are to invest in the first place. Okay, so the key findings across these three mechanisms in the literature is that the cost of debt tends to be more affected by macro factors like interest rates, inflation, and so on, as we're seeing obviously right now, and micro factors like creditworthiness of individual firms. Improved liquidity lowers the transaction costs between firms, and it can incentivize longer-term investments in aggregate. And as we've seen, particularly in the very high-profile case of the hedge fund Engine Number One and ExxonMobil, investors can use their shareholder rights, even when they don't earn much of the equity of a firm, to have a significant influence over corporate management and practices. And of course, there are spillover effects over disclosure of information, leading to more efficient markets, a positive externality, and of course, positive and negative feedback loops that can exacerbate crises or dampen them. Applying this to sustainable finance, what are we trying to do? Well, on the cost of capital, essentially, we're trying to drive a wedge between the cost of capital for sustainable and unsustainable projects, in essence. That's the link to the real economy. There's some evidence for this emerging in some of the high-profile types of project. Coal is a clear example, but when it comes to oil and gas, it's not really happening yet. There's not any clear evidence, really, that we can find that sustainable financial instruments or access to them improves the liquidity of firms, but this may yet change. And there is some fairly broad, but not necessarily very specific or insightful empirical support for how engagement can influence corporate management and practices, particularly in the climate context, but not exclusively. So very briefly, I'll try and wrap up in the next 3 minutes, if that's okay. Amanda?
You're doing great.
Okay. We think about how these transmission mechanisms work across asset classes. So we look at passive and active equities, bonds and loans in the fixed income markets, and in brackets I've got the approximate size at the end of 2020 of outstanding instruments in these, outstanding value in these different asset classes. Private equity, which is much smaller, potentially very important, real assets, and hedge funds that are sort of an asset class, but not really, but they do deserve separate treatment. Probably don't have time to go over this, but this is just essentially to say we approach this in a qualitative way, and we were looking at, what are the conditions under which impact can be achieved under four key descriptors, one of which is the potential for impact in absolute terms, the likelihood of that happening, the magnitude of the effects, and how persistent that impact might be. I can't really go through examples given time, but we can come back to this in Q&A. And what we find, essentially, is that, surprise, surprise, if you're trying to make an impact through public equity by buying and selling shares in public firms that have already been issued, you're not necessarily going to achieve very much, certainly through the cost of capital and liquidity channels. When it comes to loans, depending, and the reason for these ranges is it really is dependent on context and on the nature of the firm and how much access to capital it has. If you are one of 2 or 3 lenders to a company and you say, I'm not willing to give you access to working capital at this rate anymore unless you do X, Y, Z, in principle at least, your impact on the short-term cost of capital can be very high, and similarly in bond markets. Yeah, there's far too much material here, clearly. So just to kind of conclude, I think, I'll just give you an example of what our conclusion was for this paper, hypothetically, for what an impact maximizing fund in one of these asset classes might look like. So in this case, it's a bond fund. What might it do? Well, on the cost of capital side, incentivize issuers to lower their cost of capital through standardization of their issuances and use of sustainability-linked bonds and loans, working with issuers on their capital structure, on the conditionality and the KPIs associated with sustainability-linked loans. I haven't discussed exactly what those are because of time, but we can come back to it. and steadily and predictably exclude the worst performing issuers in a given portfolio via internal hurdle rates that rise over time. And the predictability and clarity over which these is communicated is almost more important as to how stringent they are. One of the main issues with access to liquidity is inclusion in indices, particularly in a world where so many assets are being traded on passive strategies, index-linked strategies. If you're not in the index, you're not going to get access to any of that, and that is the case for a fairly large chunk of the green bond market. It's just simply too small to be included in a lot of these indices, and bond funds certainly have a role in how the composition and the rules governing who is and who is not included in these indices can be changed over time. On engagement, the conclusions are fairly obvious, but still not being followed, particularly in fixed income markets. Publish a net zero emissions compatible stewardship strategy that's very clear on what's going to be required. Maximize new and transitional financing as opposed to refinancing, which would need to be explicitly justified in specific circumstances to allow the freeing up of capital for a firm that may, for example, need to refinance an existing asset to be able to invest in a transition asset or a retrofitting or a new fuel source for a steel plant, for example, that may or may not be hydrogen, and systematically engage with issuers on long-term strategy. Don't have time to go through that, but just a concluding point. Of course, most portfolios are not just one asset class. So one of the conclusions from our work is if you do have differential potential for impact across different asset classes, taking into account this type of thinking would be important for strategic asset allocation among multi-asset portfolios. So I think I'll just restrict myself to the second and third points, which is if you are a multi-asset, if you are in control of a multi-asset portfolio or something similar, it would be important to start weighting the allocation of capital towards asset classes in which it's possible to have a high impact. And our preliminary analysis suggests more fixed income, more private equity under certain conditions as part of a strategic process. And secondly, similarly to the risk-return budget that's traditionally used for asset allocation, to establish and start explicitly accounting for and using an impact budget across a portfolio. I think with that, I'll wrap up, other than to say these are sort of what we're planning next. Of course, this is fairly qualitative in nature. It's based on detailed interviews with people across the financial system. But a lot of these hypotheses need to have empirical support or otherwise to be validated. We need to understand the dynamics of how they interact with each other, how big these effects might be, and understand the complexities of the interactions between the mechanisms and between asset classes as well. I'll stop there. Hopefully I didn't go over too much.
You've done very, very well.
Thank you.
Thank you. Andrew?
Okay, I'd like to start by thanking the conference organizers, Lily and Nathan, for bringing us all together and creating this wonderful event. And also want to thank our fearless session chair, Amanda, for getting us together and holding a prep call despite the challenges of actually scheduling a time. So if the session looks like we actually coordinated, it's thanks largely to Amanda. So my focus is going to be on quantification, the quantifying of the impact on financial risk and reward of impact investments. And this is co-authored with my colleague, Reixin Zhang at Peking University. So I want to start first with defining some terms, because we're using impact investing in lots of different contexts, and different people have different meaning for it. So I'm going to be using a very broad definition of impact investing. My notion of an impact investment is any investment that is for purposes other than solely to maximize risk-adjusted return. That's something that financial economists have been studying for decades, and portfolio managers do routinely. They maximize risk-adjusted returns. But things like divesting from stocks that are engaged, that were companies that are engaged in objectionable activities like apartheid, fossil fuels, tobacco, sin stocks, ESG, socially responsible investing, sustainable investing, all of these ideas of investing for goals other than just to maximize risk-adjusted return, I'm going to include in this broad bucket of impact investing. And so the question that my co-author and I started out with is, given all of these disparate goals, what are the consequences for financial risk and reward? Because as a portfolio manager, particularly if you're managing money for public institutions like a pension fund, you have an obligation to focus on maximizing risk-adjusted returns. In the United States, there are regulations, specific regulations that govern fiduciary duty, which include things like acting in the sole interest of the participants of the plan and the beneficiaries, and engaging in careful, responsible, and prudent investments. That's part of the law. And if you deviate from that, you can be sued and prosecuted in a number of different ways. The question is, does impact investing, all of the various different kinds that I had in the previous slide, does that satisfy a fiduciary's obligations to focus on the particular participant? Does impact investing necessarily, as some people argue, lower your risk-adjusted return? And most importantly, can we come up with a framework for thinking about this? Now, this is not just a random set of academic questions. Many of you know that in the state of Texas, there are now specific challenges against companies that engage in ESG investing. And not only challenges, but the Attorney General has actually forbidden certain companies from doing business with the state of Texas if they engage in divesting from fossil fuels. I mean, these are pretty serious issues. So the framework is really what Rachin and I are looking to do. And what we're showing you, what I'm going to show you is a few examples of what we're trying to accomplish. I won't have time to get into the details since we only have 10 minutes, but what I'd like to do is to give you some motivation and have you take a look at the paper if you think this might be relevant for you. I want to start with the motivation that actually I began with as a finance professor, trying to understand what all of the fuss was about impact investing. The traditional way that financial economists think about investing is this. We're going to maximize an objective function for an investor. And the objective function that's typically used is some kind of expected utility measure. So, given that I'm from MIT, every slide that I use has to have at least one equation on it. So this is my equation. Imagine that we're going to maximize the expected utility of an investor using a given universe of securities, 1 through n. And suppose instead of using that entire universe of securities, we just pick a subset. For example, we pick the top decile of green companies, or we decide that we want to focus on the lowest decile of those that are engaging in some objectionable activity. That's a subset of the entire opportunity set. Most financial economists have argued that when you do this, when you restrict your universe to a subset of ESG companies or some such impact measures, then necessarily you are going to make your investors worse off. You certainly can't make them better off, right? Because maximizing an objective function across an entire universe of securities versus maximizing it over a smaller subset can only make you worse off, right? You all agree with that? Wrong. Sorry, I teach online a lot, so I got to have sound effects to keep my students awake. This was a big shock to me. It turns out that this is not correct. In order for the result to hold, there is a version of it that does hold, but you need to add one more implicit assumption that most economists don't talk about in polite company. And I'm going to tell you what that is, but I'm going to do it through a way of an example. I'd like to offer an investment fund and ask whether you would be willing to invest in me, in my fund. It's called the Andrew Lo Fund. Let me tell you what it is. I'm going to start with the list of the S&P 500 companies, and here they are, a few of them from the list of 500. And what I'm going to do is I'm going to pick those companies that have names that contain my initials, A and L. You laugh, but wait till you see how this works. If I go down this list and I just pick the companies that have my initials, well, I get a subset. I'm getting Apple and Alphabet and Tesla. Those are pretty good companies, right? So this algorithm might actually work. How many of you will be willing to invest your 401k in my fund? Well, thank you. I get one or two sympathy votes. But most of you won't. And why? Why wouldn't you invest? The reason is, of course, my criterion, my sole investment criterion, has nothing to do with performance. It's ridiculous. And if you invest in me as a fiduciary, you will be violating your obligations to look after your clients. Okay, so this is an illustration of that theorem that I showed you in the previous slide, that if you start using these random concoctions of subsets, you're going to make people worse off. All right, let me give you a second example. The second example I'm going to call the Warren Buffett Fund. And let me tell you how this works. This has nothing to do with Warren Buffett, other than in one very specific way that I'll describe. I'm going to start with the same list of companies. But what I'm going to do is to restrict myself to a subset of these companies. And what is that subset? It's the subset of companies that Warren Buffett will be investing in over the course of the next 12 months. Now, you might ask, how do you know what he's going to invest in? Well, never mind how I know, but let's suppose that I do. Maybe, I know the janitor who cleans out the Berkshire Hathaway office, and they look in the wastebasket and they see the companies that are circled in red. Or maybe Warren Buffett's a close friend of mine and he's willing to give me a little, bit of his tips. Whatever the reason is, if I can guarantee you that I will be able to come up with a list of companies, not that he's already invested in, but ones that he will invest in over the course of the next 12 months, I will be able to pick those exact same stocks on or before the date that he enters those trades. That's my trade list. That's my portfolio. How many of you would be willing to invest in this fund? Wow. I'm hurt. You won't invest in my fund, but you'll invest in Warren Buffett's. The answer is, of course, you would invest, because there's information contained in that selection criterion. So where that theorem on the first slide went wrong is I have to specify that the subset of securities that I pick have no information content in them and are not correlated with anything about the risk and reward of the member assets. And you see, most people don't take the time to specify that. But if you don't, then you're going to get very, very different results depending on whether or not the criterion actually contains information. Let me give you an even more stark example. Suppose that my subset of securities contain only those securities that will go up in price over the next 12 months. Clearly, you would prefer my subset to the entire universe. Clearly, my subset is going to perform better than the entire universe. It has to, by definition. Now, we can argue about how you can do this. In fact, unless you can see the future, you can't do this. But what this illustrates is the central point of our paper, which is the key to whether impact investing has any financial consequences, good or bad, is completely tied up in the question of, does the subset of securities that you pick, does that subset have any relationship to the future returns of the securities in that portfolio? If the answer is no, it doesn't, then like my fund, it can't possibly help, and it will almost surely hurt your performance. And so the standard financial bias against ESG and other impact investments holds true. If you start making random claims about constructing, things that are useful for the planet, but not necessarily for financial returns, you're not going to be doing your investors any favors, even though you may be helping the planet. That's a separate issue. However, it turns out that if you can show that there is a correlation between your impact criterion and future returns, that opens up a whole new dimension of risk and reward. That says that an impact investment can also be financially impactful or possibly financially hurtful, depending on the nature of your criterion. So what we do in the paper is to quantify this. We show that if it turns out that the correlation is positive between an impact measure and the ultimate future returns, if the correlation is positive, then impact investing can actually be very positive for investors. On the other hand, if the correlation is negative, then impact investing can be extremely costly to those investors. And we provide a formal mechanism for showing how to do this. A mathematical and econometric set of tools that will allow you to make these determinations. And then we also give 4 examples. So in the last few minutes, let me just go through what those 4 examples are very briefly, and then I'll wrap up. The 4 examples illustrate the complexity of measuring the impact of impact investing, and it gives you 4 kind of different case studies of what that impact could be. The first is sin stocks, tobacco, gambling, pornography, firearms. If you decide that you do not want to condone such activities and will divest from these sectors, well, many impact investments are exactly in that domain. It turns out, though, that because these companies, these sin stocks, are highly profitable, if any of you are wondering about that, take a look at U.S. Tobacco, which is now part of Altria. But before that, when it was a separate company, there's a Harvard case study about Altria and then about, before it, U.S. Tobacco. U.S. Tobacco is one of the most profitable companies in the history of the U.S. stock market. What do? They make smokeless, moist tobacco, chewing tobacco, the stuff that you stick into your cheek. If you're a baseball player, you're spitting all over the place. It turns out that that product causes cancer. In fact, they were forced to put a label on their canisters that say, this product causes cancer. And yet still, people buy it. It is so profitable that this company, over the course of a 37-year period, had increased earnings year after year after year for 37 years. So, what's the point of this? The point of this is that these stocks, the existence of these stocks is going to be negatively correlated with returns if you're going to divest from them. If you decide not to hold these stocks, if you decide to short sell these stocks, make no mistake about it, that might be the right thing to do from an ethical perspective, but you will hurt your investors' returns, and you need to let them know that. They may still want you to do it, but in terms of the quantification, there's a negative impact. Second example, venture philanthropy. Things like the Cystic Fibrosis Foundation, which is a nonprofit organization that invested in a number of biotech companies to create a drug for cystic fibrosis, including this company based in my backyard, Vertex Pharmaceuticals. So a nonprofit organization couldn't care less about profit, invested over the course of 7 years, something like $150 million in Vertex, just giving them money to run clinical trials and develop drugs for this disease, cystic fibrosis. In 2012, the first ever drug for cystic fibrosis was developed by Vertex. And that drug and several others all created tremendous profits for the CF Foundation. Over the course of the last few years, they've sold their interests in these profits for about $4 billion. $150 million investment, $4 billion payoff. That IRR beats any investment manager that I know of, including most hedge fund managers, with the possible exception of Warren Buffett and Jim Simons. That's an example where impact and profits are positively correlated. So that's an example where if you want to engage in that kind of impact investing, congratulations, your investors are going to be very richly rewarded for that objective. Third example is ESG. We look at a number of ESG scores and we calculate the impact, the financial impact of ESG. For certain scores, it's actually positive, but for others, it's negative, depending on the nature of the score and what that portfolio is targeted to do. And finally, even something like meme stocks, like the GameStop episode that happened in 2020, in those cases, you can argue that the particular individuals that are trading in GameStop, they were looking for impact. They wanted to punish the short sellers. They didn't have a financial goal in mind. They had a social goal in mind. And it turns out that for certain types of impact investing in that domain, for meme stocks, that can actually be profitable for investors. The correlation can be positive. Okay, so let me wrap up by saying that not all impact investments are created equal. We have a framework for thinking about it. Positive correlation means social impact and financial impact go hand in hand. Negative correlation means that they are going in opposite directions. And the point is that you can even optimize the financial consequences of this type of impact investing in our framework. But the key point is that you have to measure it, and then you have to disclose it. There's a lot that we can do with all of these impact investments. We can actually do well by doing good in certain circumstances, but we should at least know what we're getting and disclose that to investors. Thank you.
Thank you very much, Andrew. Simon?
All right. Well, it's an absolute pleasure to be here, and special thanks to the conference organizers for putting my paper on the program, and special thanks to Amanda for organizing the session. So today I'll be presenting a paper titled Environmental Regulatory Risks, Firm Pollution, and Mutual Funds Portfolio Choices. So what's the motivation of this paper? Well, recently, institutional investors have become increasingly concerned about environmental risk. And in particular, environmental regulatory risks have been identified to be of paramount importance, especially over the next 5 years. And many institutional investors believe that such risks are already starting to materialize. And so the burgeoning literature in this area has primarily looked at the pricing implications of regulatory risk. For example, the pricing of municipal bonds, corporate bonds, bank loans, and shareholder wealth. But there has been relatively less work that looks at how environmental regulations interact with firm pollution and their combined impact on investors' rational investment decisions. So this paper tries to fill this gap in the literature by looking at a very important group of investors whose trading we can observe, specifically mutual funds, and examine how they rebalance their portfolio holdings of these polluting firms in response to environmental regulations. So what's the regulatory setup of this paper? Well, we focus on a key regulatory component of the U.S. Clean Air Act, known as the National Ambient Air Quality Standards, or NAAQS for short, for ozone pollution. Okay? So what are these regulations? Well, essentially, each year in the U.S., the EPA will designate every single county into what's known as attainment or non-attainment status. Okay? So on the left-hand side here, we have an example of an attainment county. So attainment county is where the ozone concentration levels of that county is below a specified threshold known as the NAAQS threshold. And if this is the case, then the county is designated compliant or attainment. On the right-hand side, we have an example of a non-attainment county. So this is just the opposite. If the concentration levels in that county is above the threshold, the county is not in compliance, and we call that non-attainment. So what's the implication for firms? Well, firms that operate polluting plants in these non-attainment counties are going to be subject to more stringent regulations and mandatory pollution abatement requirements, which leads to additional regulatory costs. And the important thing to notice here is that these regulations or non-attainment designations are binding, in a sense that they have a material impact on the firm's polluting behavior, and this leads to an increase in the compliance costs compared to those firms that operate only in attainment counties. So in this paper, what we do is we use these local county-level ozone non-attainment designations as an exogenous source of variation in local regulatory stringency, which represents a negative shock to the cash flows of the polluting firms that are exposed to these regulations. So what's the hypothesis that we put forth? Well, the idea here is that mutual funds are going to optimally adjust their portfolio holdings to essentially hedge against this regulatory risk. Okay? So the literature has kind of looked at ESG preferences as an explanation. The idea here is that, if consumers have green tastes and combined with ESG demand, this is going to lead to consumer preferences for green holdings and pressures on institutional investors to divest from brown firms, which means that green stocks could potentially serve as a hedge. On the other hand, you could argue that, well, the increase in regulatory stringency is precisely due to the fact that brown firms' output has increased, and so that means this is going to lead to an increase in the returns of these brown firms, and perhaps brown firms serve as a better hedge. And so ultimately, whether green or brown firms are better hedges is a empirical question. And so the mechanism we put forth in our paper, we also talk about this hedging argument, but the mechanism is very different with respect to the existing literature. And here, what we talk about is essentially a negative shock to the cash flows. And the idea is as follows. So firms that operate ozone-polluting plants that have a greater exposure to these non-attainment designations are going to have greater regulatory costs. Okay? And this is going to negatively impact on the firm's fundamentals, for example, riskier operating cash flows. And so funds are then going to optimally adjust their holdings depending on how the cash flows of these stocks co-vary with the regulatory shock. Okay? So stocks that perform better when there is a non-attainment designation will serve as a regulatory risk hedge, and they're going to be overweighted. And vice versa. Stocks that perform poorly are going to be underweighted. So which firms are going to be underweighted? Well, the cool thing about this regulatory setup is that not all polluting firms are regulated uniformly. So what do I mean by that? So consider the left-hand side where we have an example of an attainment county. And you could have a firm. It operates all of its polluting plants in this attainment county. It emits a lot of ozone, but it's effectively unregulated, right? Because the county is in compliance. On the right-hand side, we have an example of a non-attainment county. Okay, again, you could have a firm. It operates all of its plants in this county, but it doesn't emit ozone. Okay, so it emits other pollutants like PM 2.5. And again, this firm is effectively unregulated because it doesn't emit the pollutant that's being regulated. So, which firms are most negatively impacted by this non-attainment regulatory shock? Well, the literature has kind of identified two types of firms. Okay, so the first type is what we call a multi-plant firm. So a multi-plant firm is essentially a firm that operates plants across multiple counties, and these firms are shown to have higher production costs. And then we have a heavy ozone polluter. Okay, so a heavy ozone polluter is basically a firm where the ozone pollution forms a large proportion of its overall emissions, and these firms are also shown to have higher pollution abatement expenditures. So taken together, a firm that is both multi-plant and a heavy ozone polluter are going to experience the most negative shocks to their cash flows when this non-attainment regulation is imposed, and these are the firms that we expect to be underweighted. Okay, so let me just quickly go through the methodology of the paper. So this figure essentially shows the changes in the non-attainment designation status. So there are two ways which a county can go in and out of non-attainment. So the first way is potentially endogenous in the sense that a county's ozone pollution levels can rise, surpass the NAAQS threshold, and as a result get designated as non-attainment. Now that's endogenous because counties where there's more local economic activity are going to be, will naturally have higher outputs, and as a result, this non-attainment designation status is going to be endogenously determined, right? So we don't focus on that. What we do focus on, however, is on non-attainment designations that's induced by changes in the policy that determine the NAAQS threshold. So as you can see, there's kind of 4 peaks in time here where essentially the EPA essentially changed the NAAQS threshold such that many counties suddenly found themselves to be in non-attainment relative to the prior year, even if their pollution levels remain constant. Okay, so this suggests a very natural setting for difference in differences. So essentially, what we do is on the left-hand side here, we look at the change in the average portfolio weights of a given stock. And on the right-hand side, we have kind of 2 key variables. Okay, so we have this NA ratio, which essentially measures the proportion of polluting plants that's located in non-attainment counties, and this ozone ratio, which measures the proportion of air emissions of a given plant that is classified as ozone. Okay, and the prediction here is that the coefficient on this interaction term, beta 3, is going to be negative. Okay, so let me just kind of show the results. So as you can see across kind of all specifications, we have this negative and significant coefficient on the interaction term, which means that funds are essentially underweighting the firms that experience the most negative shocks to their cash flows. Okay, I'll talk about the extensive margin effect, which is quite substantial. So if you compare a firm that operates all ozone polluting plants, okay, and this firm is completely exposed to non-attainment designations, compared to a firm that operates only non-ozone plants without any exposure to non-attainment, experiences roughly a 10% drop in the dollar value of holdings, and that's very substantial. You can also see that the coefficients on the single terms, the NA ratio and the ozone ratio, these are positive and significant. Okay, so what that means is that there seems to be a reallocation going on, right? So essentially, firms that are not affected by this non-attainment designation are essentially overweighted. Now, as with any diff and diff, we kind of do an event study and look at the changes in the weights from 4 quarters before to 4 quarters after the non-attainment designation. You can see that there is kind of no difference in the portfolio weights in the period prior to this non-attainment designation shock, but there's a clear, sharp drop in the weights that coincides with the non-attainment designation quarter. Okay, so in the paper, we do a whole bunch of additional tests to really kind of pin down that this is kind of a optimal adjustment in response to regulatory risk. Okay, in the paper, we also look at a few other regulatory events just to kind of give some more validity to the main hypothesis. So the other regulatory shock we look at is called a bump up. Okay, so a bump up is essentially very similar to a non-attainment designation, except that it is conditional on a non-attainment. So if the air pollution levels in a particular county doesn't improve over time, the county gets bumped up from a lower classification to a higher one. And the result is that, we expect funds to continue to underweight the most negatively impacted firms. And they do. So if you look at the interaction term, it's negative and significant. Okay, so here's the event study figure. Again, no pre-trends driving the results, a clear, sharp drop that coincides with the bump-up quarter. And the last kind of sanity check we do is called an attainment redesignation. Okay, so as the name suggests, the redesignation occurs if the air quality in a particular county improves substantially such that the regulation is essentially lifted. Okay, so attainment redesignations represent a relaxation in regulatory stringency, and we should expect the exact opposite effects, and we do. So if you look at the double interaction term now, it's now positive and significant, indicating that firms that experience a positive shock to their cash flows are now overweighted. And again, the event study figure shows that there's kind of no pre-trends driving the results. And so kind of in the last part of the paper, we look at an alternative explanation known as the salience hypothesis. So we recognize that, this underweighting that we observe is also consistent with this behavioral explanation in the sense that, a fund manager that has some sort of local exposure to this environmental risks will essentially overestimate the impact on the affected firms, and as a result, they're going to underweight the affected stocks. And so in our setting, what this implies is that, if a firm has if a fund manager has some sort of local exposure to ozone polluting firms, then they're going to overestimate the costs of non-attainment to that firm, and as a result, they're going to underweight. But this is not a rational response. This is due to overreaction. Okay, so we try to kind of distinguish between the rational hypothesis and the salience hypothesis. And what we do is we focus on the post-non-attainment period and look at the performance implications. And the idea here is that, if the result is driven by salience, then one should expect return reversals, right? Because this is due to kind of an overreaction. On the other hand, if we experience if we observe a decrease in the operating performance of the affected firms, a decrease in abnormal stock returns, an increase in the fund's portfolio's performance, this is going to be evidence in support of the rational hypothesis. I'm not going to go through results for the interest of time, but we kind of show that the second part holds, right? So there's going to be essentially kind of a decrease in the operating performance of these most affected stocks. Okay. So let me just conclude. So in this paper, what we do is we look at mutual funds portfolio choices in response to environmental regulatory risks. What we focus on is, this cool institutional setting known as non-attainment designations, and we find that, funds essentially underweight the stocks whose cash flows covary negatively with the regulatory shock, and vice versa. They overweight those that correlate positively with the regulatory shock. So what are the firms being underweighted? Well, these are heavy ozone polluters that operate multi-plant firms, multi-plant across many counties. And so kind of some food for thought for the future is that, these environmental regulations, have important implications for the allocation of capital of these polluting firms in the financial markets. So, what we show in this paper is that, well, if you kind of shift capital away from the biggest polluters, this is going to increase the value of the fund's portfolio holdings. But on the other hand, this could be detrimental to overall welfare because, these are precisely the firms that need funding to transition to a greener economy. And I think, it's very exciting for future research to look at kind of this regulation-induced capital allocation. So thank you so much for your time.
Great. Well, you guys were all very self-regulating, so I didn't even have to say anything about time. Thank you all for those presentations. Really impactful, I think. So why don't we open it up to some questions? Lily has the mic over here, over there.
Hi, thank you very much for your presentations. My name is Bruce Kahn. I'm from Columbia University and Shelton Capital. Professor Lowe, thank you for your presentation on impact investing. I wonder what you think about the idea that was exhibited by Peter Thiel's book, 0 to 1, in terms of motivation. I'm honing in on your point about what's your motivation of putting capital to work. So, we saw an entire societal change because of those investments in social media. And when they were doing that, they were like, this is an industry that doesn't exist, and this can affect society. And then we saw what happened. And I think that's categorically different than like saying, hey, there's a good drug that could potentially be worked out that might make money. That's kind of established, right? This was like not an industry, could have incredible social impact and incredible financial returns, but might also go belly up. So how do we distinguish what our motivations are when we're talking about this topic?
Yeah, that's a great point. I think that the way that the U.S. legal system distinguishes it really has to do with corporate governance and disclosure to investors. So in the case of the companies that Peter is referring to, those are examples of entrepreneurs like Elon Musk and others who had a very, very specific vision. A vision of a world of electric cars, a vision of electronic commerce, but one that investors bought into. Now, that might not be their motive. Their motive was to create this vision of a world with fewer standard combustion engines, but they were able to align that vision with investors that are looking for a rate of return. And those investors included pension funds. So that's actually kind of my point, which is that impact investing doesn't necessarily have to be counterproductive to financial return. But you need to have disclosure and you need to have the ability to measure. So in the case of a company like Tesla, investors bought into the idea that initially it was not going to be profitable. It was going to take a long time to create the infrastructure needed for electric vehicles, but they felt that not only was the vision something that they backed, but that from an investment point of view, it was actually going to earn a rate of return. And they were right. They actually got a great rate of return. With every one of these Teslas that we laud, there's probably 100 companies that tried to do similar things and went under. And so that's the risk-reward trade-off that financial economists talk about. As long as you disclose that risk-reward trade-off, there are investors out there that are willing to take those kinds of risks. But the key is to be able to disclose it. Otherwise, you get into trouble with the state of Texas, with the SEC, and all these other restrictions that require investors to be to managers to carry out their fiduciary duties to investors.
So, Andrew, thanks for your fascinating talk. I think you made a very convincing case that restricting your investment portfolio to a subset can deliver impact and returns. My question is, if we want this impact of impact investing to really have the impact, the scale that is required given the, that is commensurate with the scale of the climate crisis, how could regulation or something else make it more often the case that indeed those impact assets are the same as the type of investments we must do to decarbonize the economy?
Yeah, well, this is actually related both to some of the work that you cited in your talk as well as to what Alex was referring to in the fact that a green company doesn't necessarily mean that it's going to make the planet greener. And that's the same thing with financial securities. A green security doesn't necessarily lend itself to decarbonization. So two things. One is, I think, having better metrics to show what the impact is of an impact investment, and then to then disclose what the financial consequences of that impact is. I think that's one step. But I think an even bolder step is something that you and Patrick are working on, and I think others in the financial realm, and that is to create financial securities, derivative securities, that are specifically geared towards paying off when there is measurable impact on the environment, whether it's climate or precipitating greenhouse gases or dealing with fusion energy, but specifically to align the interests of society with the interests of the investors. It's not impossible, and it's certainly, if you can do it, what that amounts to, one of my graduate students said that what I've been writing about is an attempt to weaponize the financial system to deal with these societal challenges. Now, I'm not a big warmonger, so I don't like to use these kinds of analogies, but the idea of using the financial system rather than letting the financial system use you, using the financial system to target specific societal goals where you disclose to investors exactly what the consequences are, I think that is really what sustainable finance is all about and what this conference is all about.
And can we talk a little bit about the difference between divesting and investing in transition? Because just simply avoiding those stocks or saying I'm not going to finance fossils, somebody is, at least currently, because it's still financially viable to do so. And so how do we think about moving to Alex's point, something in the real economy, so not just divesting and saying I'm not going to invest in these types of stocks, but instead saying I'm going to invest in them and require improvement. How do we make sure that's happening in the financial system as well?
Should I kick us off?
Please.
Great question, and this is kind of underlying a lot of the work that's been presented here. Is even if you do end up with excess returns from green stuff and you invested a bunch of green stuff, there's plenty of non-green stuff still out there that needs a lot of capital to get to where it needs to go. And in some cases, and it's very important to be subtle about this, there are companies that really have not made the right investments, they do not have the right capital expenditure plans or any credible way to net zero, and they will need to shrink and eventually disappear. But there are plenty of others where, and we're thinking of industries like steel and cement, for example, where no one really has a way of decarbonizing a massive set of steel assets tomorrow or even next year or the year after that. And it's not necessarily linked to a failure of their strategy. It may be linked to other policy failures like limited support for R&D in green hydrogen or limited deployment instruments, that sort of thing. And there's a real challenge distinguishing between the two. When coming back to, I think, one of the points I made halfway through on, for example, bond funds, there are ways that you can start to use the financial system to incentivize some of those steps without having a sort of massive shock to ESG in the short term, which is the big risk of all this. If you suddenly say the ESG emperor has no clothes, which everyone is busy saying right now, the risk is that a lot of this well-intentioned capital is just going to find itself in breach of regulation or whatever, or at risk of court cases and so on. But if you are a bank or you are an asset manager, giving your investee companies clear signals on, by this date, we need to have a clear plan from you on what you're going to do with these assets. And that could be winding them down. And it could be, advocating for policy that helps them to retire some of these assets, as we're seeing with coal. Or have a way to convince us you're going to make money from the strategy you have to turn these things around. And it's not very clearly one or the other for a lot of these industries, and there's still a lot of uncertainty. But it's still a big unanswered question.
Can I follow on that
Please.
point? So let me answer Amanda's question in a couple of different ways. First, if you think about divestment, that is essentially a kind of an abdication of a particular sector. And if everybody does it, that certainly could have tremendous impact. But the problem is if everybody doesn't do it, then it's not clear what the impact is. To your point, if you're selling it, somebody else is buying it, the whole point of being able to sell it is you found another buyer. And it's not clear that that's going to have the necessary desired long-term effect. The second point about what you should invest in is really where I think the answer is. In order for us to, let's take the example of climate change specifically. In order for us to sustain the human population, we're going to have to find a sustainable source of energy. And based upon the various different studies that I've looked at, and I'm not an expert in this by any means, there are many people in the audience who know more about than I do, but one of the sources of fuel that is going to have to be a reality is fusion energy. And over the course of the last 5 years, there's been tremendous breakthroughs, some of it happening at MIT, which is why I know about it, that makes fusion energy possible. So we're probably 5 years away from a truly exothermic fusion reaction, and then probably another 5 or 10 years after that to make it commercially viable. So the 5-year plan that MIT is undertaking to build a truly exothermic fusion reactor, it's being built 45 minutes outside of Boston. I saw a photograph of it. Do you know how much concrete they're using to create that fusion reactor? Huge amount of concrete. And the point was made to be by the director of the MIT Plasma Science and Fusion Center that we're going to have to burn a ton of fossil fuels in order to achieve fusion. And so that means that rather than divesting from these companies, we need to have a plan for using them and transitioning and then helping them to pivot out of their existing fuel sources into the fuel source of the future. But you can't just expect people to give up their livelihoods and put down their fossil fuels until and unless you give them an alternative and start investing in it and then have a plan for transition. So I think that deals with the issue of what to invest in and what to divest from. You have to have a plan to coordinate both.
And in fact, you have to keep them in business. You have to allow them to
'cause we
continue
need the concrete.
profitably being in business until we get to that point. And then
That's right.
the build out of transmission has been quite delayed as well to getting renewable sources where they need to be. But enough out of me. I think there's some questions up there.
Yeah, sure. Ilmi Granoff, Columbia Law School and LSE. Question for Alex. Your overview focused pretty clearly on the sort of independent variable, sort of what things that financial institutions can do to have an effect in the real economy. But I'm less clear on what you think of as the dependent variable, what effect you're talking about. Is it notionally just that we'd measure it in terms of reduced emissions ex post further down the road? Or are there any kind of intermediate dependent variables that look like the effect that we would see, for example, on non-financial corporates that make a series of decisions that create emissions, that we could identify as the outcomes that those actions of financial institutions cause? It's a little more on the dependent variable side, if you could elaborate on how you're thinking about the effect.
Thanks, Ilmi. That's a great question. And we kind of elaborate a bit more on it in the paper, the longer paper that's associated with this. But the idea is not necessarily to think about a very specific example. I mean, net zero and emissions-related metrics are the obvious example, where you'd either be looking at expected emissions or emissions intensities over time. You can have reasonable disagreements about which one of those is relevant and probably differs by industry. But what we're trying to do more broadly is think about, regardless of the dependent variable, what are the key criteria that the financial sector needs to be following in order to have any pathway towards actually having an impact. So it could be the emissions in net zero case, but it could also be human rights violations. It could be risks associated with localized environmental damage, that sort of thing. So I know that's probably not a very satisfactory answer, but it's not really one that we're interested in looking at in this paper. But it's definitely an area for further conversation.
Brian Burton here. So question for Alex, maybe Andrew. When I think of green securities, I think of them as, instruments that enable or provide capital companies to either reduce carbon, remove carbon, avoid carbon, for example. So when you say, green securities don't necessarily have the impact that investors may think they do, what do you mean by that? And is it just that all green securities or green bonds aren't created equal and perhaps aren't well designed, or is there something more to it than that?
Maybe I'll just very quickly respond. So there's a distinction to be made between a green security that was green before you bought it or had any interest in it, and versus one that is made materially more green, or whatever your marker is, by the fact that you've either bought it or engaged over a period of time with the company in question. And I think we're really confusing the two, or not really, in general in the ESG space, not really placing any emphasis or requirements to show that the second one is happening. So my decision as a portfolio manager, or whatever my role happens to be, has led to, either as a discrete event or over a longer period of time, a material change in how this company is allocating its own capital expenditure, how it's, maybe it's corporate restructuring and so on and so forth, and have, getting back to the transmission mechanisms that we've hypothesized in this paper, am I really affecting the bottom line of that company enough that it's incentivized to make a different calculation as to what its capital expenditure is going to be? Cost of capital is one way of doing that, but another way of doing that is limiting or expanding the pool of capital. And green bonds are a good example. There's a lot of conflicting conclusions in the literature about whether there is a green premium or there isn't. And actually, with the practitioners that we spoke to, it's not really to do with cost of capital at all. It's to do with access to capital. So, particularly for smaller issuers who have not tapped the markets before or are really in the early stages of doing so, a green bond can be very beneficial because it gives you access to a wider pool of investors than you might otherwise have, which is almost the reverse of what you were discussing, Andrew. And we're just not really having that conversation in any sort of robust way at the moment. So that's what we're calling for.
Yeah, so I think I had the same perspective with maybe one slight difference. Certainly, greenwashing is what I was referring to as one aspect of investing in securities that are supposed to be green but aren't actually engaging in the kind of activities that will have an impact. But there's a more subtle aspect of it, which is that even if companies are engaging in active, environmentally friendly policies, the horizon over which they have that impact could be much greater than what an investor is expecting. So, for example, if you invest in electric vehicles, there are a number of economists that have showed that the general equilibrium impact of that in the short run is actually increase the amount of carbon that's being thrown into the atmosphere because of battery technology. Eventually, it will turn around and be beneficial, but that might take another 10, 15 years. And so that's an example where you think you're investing in something that's green, but it's actually making the planet slightly more brown. And so you have to be more explicit about the disclosure of the horizon over which you're hoping to have the impact. And if you do, and you're disclosing it, and investors are comfortable with it, then there's no issue at all.
I would also add just, green bonds could do a far better job of quantifying the risks that they're trying to address. And so having that ratchet, whether up or down, actually tied to de-risking your business plan, as opposed to maybe it's reporting or maybe it's a slight reduction, but it's not actually tied to de-risking your business plan, which would, I think, be far more impactful.
So thanks very much for the really nice talk. So my question is directed to, I guess, a mix of Alex and Andrew. So I think you made the point, Alex, about R&D being really necessary in terms of the green technologies that don't exist in certain sectors. And I just wondered, in your classification, it wasn't clear to me where, innovative venture capital type finance would show up, because for me, that seems to be a key part of it, is the investment in green technologies that don't actually exist to actually in sectors where there is no ability at the moment, given existing technologies, to reduce emissions unless we cut consumption, which is a different route. But if we want to keep using, keep flying and things like that, for example. And then, Andrea, I was really struck. I really like the framework, and I know we've discussed it a bit before. But the venture philanthropy thing struck me as a really interesting complement to this point. And then my question there is, I guess there's a horizon point there, because I presume that payoff came over a long period, and in the short-term return was probably maybe even negative for the. And so how do we get the horizon sufficiently long on the investor side? Because for me, that's interlinked with this venture capital story. And then actually going back to Alex, whether you've actually thought about the liability structure of intermediaries as being important in their ability to foster a green transition. So, you know, those with long-dated liabilities like insurance companies and pension funds, or where equity is tied up for a long period, private equity and so on, whether the liability structure may also be a key determinant in the financial system to be able to deliver transition, say vis-a-vis investment funds, for example, which have got daily redemption.
Do you want to go first this time?
No, please.
Okay. Thank you. Great questions. Because of time, I didn't take a look at some of the really interesting asset classes, which private equity, VCs, real assets to a certain extent, which also tend to buy and hold for a very long time, or at least wait a long time for returns to be realized. This is a particularly difficult one that Bob Eccles at the Said Business School has been writing about, that private equity needs to play a very significant role in the transition. But you look at the private equity world of today, and a lot of the potential to have a very high impact on the not just the content of the R&D programs by early stage companies, but also their corporate practices from a very early stage, again baked into corporate governance as it grows, if it becomes successful and so on, is very clear, as is the impact on the terms in which capital is provided. And it's fair to say, probably on aggregate, that the private equity industry is not doing that. The question then is, is it in its interest to be being much stricter on the terms in which capital is provided, involvement in the development of corporate strategy and corporate governance, and making sure that protection against downside ESG risks is baked into how the company operates at an operational level from an early stage. And given that most stakes are either significant minority or majority stakes in this industry, there's definitely the potential there to do it, but no one's really doing it. So the question is then, if researchers were able to articulate that this is in the interest of the industry to do it, would that happen that way, or do you need much more stringent regulation? I think that's probably still quite an open question. And on long-dated versus short-dated maturities, I'm going to think about that while Andrew answers, and then I'll come back to it if that's okay.
Sure. So first of all, I can't really see audience members because the light's in my eyes, but that sounded a lot like Sujit Kapadia. Sujit, so I'm not surprised that you asked such difficult questions. Two very difficult questions by an eminent central banker from whom I learned a great deal about systemic risk. And I think these are very good examples of systemic risk. You have to think about them as a system. So your first question about correlation, you're absolutely right. If you look at correlation between biomedical impact and financial return, it is negative in the short run. Because what are you doing? You're just spending money on clinical trials. There is like zero rate of return in terms of the revenues, and all it is negative cash flows. Beyond some threshold, that correlation flips sign and it becomes very positive. So in fact, when you measure this kind of correlation, you actually have to specify what your horizon is, and you have to specify to investors what their horizon should be in order to get a reasonable rate of return. So in the case of 0 to 1, Peter Thiel's book, it's pretty clear that all of those investments were not unicorns overnight. They developed over the course of 5, 10, 15 years, and then they were massively profitable. So that's the first point. Part of the disclosure is specifying the horizon. And your second question, your follow-on, was even more subtle and important, which is that if horizon matters, then there's a term structure question here, which is in the short run versus the long run, you're going to have different financial strategies. So this is why I hope that the ESG community, the activists that started us down the path of taking these ideas seriously and putting our money where our mouths are, I hope that the activists, the next generation of them, now start getting even more sophisticated, and instead of just demanding that we divest from certain sectors and invest in others, they actually demand a plan for the transition, for that correlation to flip sign from negative to positive, and to engage in investments that take into account that flipped sign so that that's truly the most sustainable kind of finance. It's a plan, and it's a plan that involves the entire system.
Should I add just on the last point?
You should.
That's okay. So very quickly, I think this is a very, very difficult question. I'd love to talk to you about it after this. But to a certain extent, dealing with long-dated versus short-dated liabilities may be fundamentally the same, which is signals, predictability, intermediaries making clear what they're going to expect 3 months from now, 3 years from now, if they're going to, in the case of short-term loans, continue making the loans at the same rate, or in the case of bonds, to have a clear plan 3, 5, 10 years from now, whenever the maturity comes up and they're expected to buy the debt again. Ratcheting up over time, linking certain changes in the cost of capital to certain events. This is the whole idea behind sustainability-linked bonds and loans, and they're not clearly and obviously a good thing, end of story, but they do provide lenders with an opportunity to very clearly ahead of time, before the financing takes place, or in the case of refinancing on the basis of certain yardsticks, they're very clearly laid out ahead of time being met, and if they're not met, explain, or your cost of capital will go up. These are quite promising ways of dealing with this, but it's a much more complicated question than that, so I'd love to talk to you later. Thank you.
So I think we probably have time for one more.
Oh, thanks. Thanks everyone for the great presentations. Just a question for Professor Lowe. Under the framework you present, it seems like really key to ESG investing is kind of building the case for that positive correlation with expected returns. And do you think that case can be made, perhaps on the basis of, anticipating a greater proportion of investment having an ESG mandate or something along those lines? Like, do you think that case is there to be made?
I think it can, and that's a very good example of why in our paper we went through the meme stock illustration. Just to give everybody a little bit of a refresher, a meme stock is a stock that somehow captures the imagination of investors, and people want to put money in it for whatever reason. Not necessarily because of rational financial calculation, but because it's a meme. It's an idea that we all gravitate towards. The environment is a meme. And it's a very important one that has a relationship to our long-term survival. But make no mistake about it, the concerns that particularly young investors have are not necessarily rooted in the great calculation of long-term climate effects. It's that they want to see action and they want to see it now. And so it turns out that the GameStop example shows you how a figment of our imagination can actually turn into something that has positive financial return. So I don't know how many of you looked at GameStop's stock price since January of 2020 when it was trading at about $15 a share. The price seems to be around that same right now, except it's done a 4-for-1 stock split. So it's actually trading 4 or 5 times what it was 2 years ago. So the effects are not just a few days or a few months. We're talking about the meme having a long-term effect. And so to your point, Adam, we actually can construct all sorts of examples of memes that society cares about, and that caring is going to have a financial impact, in some cases a positive financial impact, and you can measure it using our framework. So that's one of the messages that we wanted to give to all those who are looking for impact investments. It's that the very desire for impact could actually have an impact on the financial returns of a given investment. You just have to measure it and then disclose it.
Great way to end. That's great. Please join me in thanking our fabulous panelists.